Hey guys, it's Dave. We're going to talk about inflation. The Consumer Price Index, or the inflation report, comes out tomorrow, April 12th, and they're forecasting a 0.3% increase for the month of March. That doesn't sound like a big number, but when you take that as a monthly number and multiply that out by 12 months, then you're looking at a 3.6% rate of inflation. Obviously, that's way lower than the 9% that we peaked at, and it's lower than the 6% that we're currently at on an annualized rate, but it is still higher than the Fed's goal of 2%. The Fed used to want to be between 2 and 3%, but I think because things have gotten so far out of control, they really want to be on the lower end of that at the 2% mark, which means we need less than 0.2 per month in order to get that rate down to the 2% rate. 0.2% in 12 months is a 2.4% annualized rate. So even if this comes in at estimate at 0.3, that's annualized out at 3.6, and it's still a little higher than they want, which means they'll probably still look to raise interest rates to try and slow the economy down and keep the prices coming down, or at least the increase of the prices slowing. We'll talk about that in a little bit, but let me show you kind of where we've been on a month-to-month basis up to this point. This is the Consumer Price Index report monthly. You can see the chart here, and you can see all the bad stuff is back kind of almost a year ago. When I worked retail, we would call these like bad comps. If we had a snow day or something from a previous year, our sales would be really low and we could easily beat those numbers. Or if it was a bad weather event or something like that, it means we had low numbers and it was going to be easy to beat those numbers. And that's kind of what I think we're up against, although it looks a little bit different because these look like big numbers and success would look like little numbers like we have over here. Even though these look good, this averages out over the last 8 months to 0.28 per month, which means if you multiply that out for 12 months, we're still at a 3.36% if we keep this trend. Still a little bit too high. So they think they're going to raise another quarter point when they meet in May. Obviously, it's data dependent. That's what they continue to tell us, that it's data dependent. And but we're looking at, every time we come up. So this February cancels out because they're showing kind of 13 months to show what last February was a 0.7. This February was a 0.4, but we're going against a 1% March for last year. So it's going to feel and look like the numbers are better, but keep in mind, it's still an increase when you talk about 0.3. That's a positive 0.3. But once we wipe these next 4 months out, you'll start to see the annualized rate, under 4%. You'll probably also see the administration brag about how they've, cut inflation in half and how things are much better, and they will feel better to see those numbers, at least psychologically. You'll stop seeing eggs and all those things continue just to grow and grow in price. But if you want to think about what this actually means in terms of your monthly budget, let's just kind of think, if you had $1,000 a month to spend, I know that's a little bit low to say if that's your entire monthly budget, but I want to keep the numbers easy. Let's say that your groceries, your gas, your utilities, your cell phone, your internet, all of that stuff averaged out to be $1,000 at the start of, let's say, 2020, when the pandemic, pre-pandemic. This is what you lived off of. This is what, if you did the same restaurant every Friday and ordered the same meal and it was consistent, it would cost you $1,000 a month to live. When you go up 9%, then you're at $1,090 in order to, that's what your cost is if you ate everything the same. So even when we go 0.3, you're still going to be higher than this 1,090. We're not going back to the 1,000, and that's the problem. So we have to have deflation in order to go back to the way things were in 2020. And I just don't see that happening unless we have some sort of crash, more than a recession, maybe a great recession. We did have deflation in 2009 when everything crashed, but we're really talking about slowing down the increase in prices every year. So, in 2021, it costs more. In 2022, it costs more. In 2023, we slow it down and it's only $10 more instead of $90 more. But we're not going back to the good old days unless we have deflation. So, what needs to happen, and this is where the Fed is in a tricky spot, is people need to get raises in order to continue to live. The problem is when you give everybody a raise, then the fear is that businesses will have to raise their prices in order to continue to make the same amount of money when they're reporting their earnings to Wall Street, and your 401k is based on stocks doing well and things like that. So they're in this predicament where people need to make more money in order to meet the monthly expenses that they have. But if you raise wages too much, then companies have to raise their prices in order to maintain the same amount of profit. And then you're stuck in this kind of wage price spiral where you have to raise prices and you have to raise wages, you have to raise prices, you have to raise wages, and that could be a mess for the economy. So I'll be watching this number closely as it relates to real estate. When the Fed increases their lending rate, then it raises your variable rates on credit cards. It raises your variable rates on home equity lines of credit. It raises rates on commercial real estate. And it also tends to affect treasuries, the 10-year note in particular, which is what mortgage rates are loosely tied to. So when that rate goes up, mortgage rates tend to follow. And so it could end up slowing the housing market down just right in the time when we're kind of getting this spring rush, and things are actually feeling pretty good in real estate right now with low inventory. We need more inventory. That doesn't feel good, but it's keeping prices from dropping, which is nice for homeowners. But we'll see about buyers. They need some relief on those interest rates. And so hopefully we can get this inflation tamed pretty quickly. So that's all that I really have for you. I'll be watching that, probably do a video on it once the information goes out and kind of see if it changes the forecast, if it changes what they might be doing in May and beyond. And stay tuned, like and subscribe if you want to see more information like that. And thanks a lot for watching.